There is a quiet frustration that a lot of you are feeling right now, and I want to name it out loud because almost nobody on the financial channels will. You have watched gold march up and up, near record highs, and you keep waiting for silver to do the obvious thing and follow, and it just sits there. It stalls, it teases you, and then slides back. And somewhere in the back of your mind, a small, corrosive voice starts to whisper that maybe you are wrong about silver. Maybe the story you believed in was never true. I am here to tell you that voice is exactly what the big trading desks are counting on. If you are holding silver in your retirement, or you have been thinking about it, this next stretch of time is going to test your nerve more than your judgment. So here is my promise for the next few minutes. I am not going to give you the surface headline. I am going to walk you through the actual machinery that keeps this metal pinned, who benefits from it, and the one moment in recent history that tells you exactly what is really going on. Stay with me, because the piece almost nobody explains, I am saving for the end. Let me give you the first real idea to chew on right now, because you have earned more than a tease. When people say silver is not moving, they are quietly assuming that the price you see reflects the metal itself, the supply, the demand, the actual bars in a vault. It does not. The price you see is set on paper exchanges, and on those exchanges, the thing that moves the price most violently is not the metal at all. It is the cost of being allowed to hold a position, and that cost can be changed overnight by a decision that has nothing to do with whether there is more or less silver in the world. Sit with that, because it is the whole story. The screen is not measuring the metal. The screen is measuring the leverage stacked on top of the metal. And leverage is a lever that other people control. Now let me take you back to the spring of 2011, because this is the story the whole video is built on, and once you see it, you cannot unsee it. Silver had been climbing for months. It was closing in on the old ceiling from the January 1980 peak, that legendary level near $50 that the metal had only touched once in a generation. Momentum was ferocious. Ordinary people were walking into coin shops. The mood was electric. And then, in a matter of days, silver fell by roughly a third. Not over a year, not over a quarter, in days. Now, here is the question that matters, the one you have to hold in your mind. In those days, did the world suddenly discover a mountain of new silver? Did every solar panel and every electronic device stop needing it? Did the mines flood the market? No. Nothing about the physical metal changed at all. Not 1 ounce of real supply appeared. What changed was a rule. The exchange that hosts silver trading raised its margin requirements over and over in rapid succession. Margin is simply the amount of money you must put up to hold a leveraged position. When they raise it, everyone who is holding silver with borrowed money suddenly has to come up with more cash, right now, or sell. Think about what that does. It does not matter how right you were. It does not matter that the shortage was real. If you are leveraged and the exchange triples the price of admission overnight, you are forced to sell into the very move you predicted. The selling feeds on itself. One forced seller pushes the price down, which triggers the next margin call, which forces the next seller, which pushes it down again. Prices cascade. It is a chain reaction, and it has nothing to do with anyone deciding silver is worth less. And the financial media, the next morning, runs the headline that silver is crashing, that the bubble has popped, that the believers were fools. Not one word about the margin hikes. Not one word that the exchange had just quietly changed the cost of holding the metal, not the metal itself. The story writes itself in exactly the direction that makes you feel stupid for believing, and that is not an accident. That is the tell. The exchange caps the cost of holding. It does not cap the metal. And when you understand that one distinction, the frustration you feel today transforms into something else entirely. Because what looks like silver failing is often just silver being held down by a mechanism most people have never had explained to them. The metal is not weak. The leverage on top of it is being squeezed. And who profits from that? Follow the money, because this is where the enemy in this story steps out of the shadows. The big banks and the trading desks do not make their living hoping you hold quietly for 20 years. They make their living on your churn, on the buying and the panic selling, on the spread every time a frightened retiree dumps metal into a dip. A calm, informed holder who understands the margin game is a bad customer. A A scared holder who sells at the bottom because the screen told him he was wrong is a paying customer. The confusion is not a bug. For them, it is the business model. And that is precisely why nobody on the financial channels will sit you down and explain the difference between the metal and the leverage. Now, let me pause here, because we have arrived at the first place where I owe you something practical, at the exact moment you are feeling most exposed. If everything I just described makes you realize how much of your retirement is sitting in paper promises and instruments you do not fully control, then you should at least know what your options are. Here is something most people never hear. The central banks of the world, the most sophisticated money on the planet, have been buying physical gold at a record pace, hand over fist, year after year. They are not buying paper claims. They are buying the metal and putting it in their own vaults. And there is a perfectly legal, perfectly ordinary way for a retiree to do a version of the same thing inside the retirement account you already have. It is called a self-directed precious metals account, and it lets you move a portion of an existing retirement account into physical gold and silver without triggering taxes and without triggering penalties, because it is a transfer, not a withdrawal. And I want to be clear, this is not some insiders-only club. If you have $100,000 or more in a retirement account, this is for you every bit as much as it is for anyone on Wall Street. We put together a free guide that walks through exactly how it works. If you were watching this on your television, just scan the QR code on your screen. If you were on your phone or your computer, go to jeffreedguide.com. Take the information, look it over calmly, and then come right back here, because the next part is where this gets even more interesting. So let me widen the lens. The margin story from 2011 is not an isolated trick. It is one example of a much larger truth, which is that the paper price and the physical reality of silver have been drifting apart for years, and the gap is getting harder to hide. Consider what is actually happening underneath the price. The world has run a structural shortfall in silver for several straight years now, where the amount used up runs ahead of the amount mined and recovered. Every year of shortfall, the gap has to be filled from stockpiles that were built up in better times, and those above-ground stocks have been drawn down year after year to plug the hole. That is not a supply that is comfortable. That is a supply quietly eating its own reserves. And silver is not like gold in one crucial way. Gold gets hoarded. Almost every ounce ever pulled from the ground still exists somewhere, in a vault or a ring or a coin, waiting to come back to market if the price is right. Silver gets burned. It goes into solar panels and electronics and medical devices in tiny amounts, a few grams here, a few grams there, dispersed across a billion devices and largely uneconomic to ever recover. Gold is saved. Silver is consumed. And a metal that is consumed while the ground is being drawn down cannot stay cheap forever, no matter what the leverage on the screen is doing this month. The screen can lie for a long time. It cannot lie forever, because eventually somebody wants the actual bar, and there is no actual bar. And here is the part that actually changes the picture, the midpoint turn I want you to lean into. There is a growing tension between where the paper price is set and where the real metal is being pulled. Physical silver has been flowing toward Asia in enormous volume, so hard and so persistently that at moments of stress, the price for real metal there has traded at a notable premium over the paper price set in London and New York. And it is not a passive flow. There has been a one-way pull, record buying of physical bars pouring in one direction, while the outward flow of refined metal gets choked off, draining Western inventories to feed a hungry industrial base that needs the real thing, not a claim on it. Read that again slowly. In the West, the paper exchanges say one price. In the East, buyers of the actual physical bars have at times been willing to pay meaningfully more to get their hands on the real thing, because a factory cannot build a solar panel out of a futures contract. When the paper price and the physical price disagree like that, it is not the physical that is lying. It is a signal that the paper market and the metal are being priced by two different realities, and only one of them is real. Paper can be printed. Metal has to be dug up, refined, and shipped. Guess which one runs out first? Now, let me be honest with you, because I will not do what the hype channels do. The inventories in the London vaults have not been draining in a perfectly straight line every single month, and anyone who tells you the shelves are bare tomorrow is selling you something. Some months the numbers tick back up. The point is not a cliff edge tomorrow. The point is a multi-year trajectory, a slow, grinding tightening in the physical market that the day-to-day paper price is designed to obscure. The screen shows you volatility, it hides the drift, and the drift is what matters for the next decade of your retirement. Layer in the backdrop that everyone can see but few connect to: silver. Gold is near record highs, even as the Fed, under Kevin Warsh, has held its ground, and policymakers remain divided, in an environment where the market is not begging for easier money at all. Historically, metal is supposed to struggle when the cost of money stays high, when a bond pays you a real return. For decades, that was the single most reliable rule in the business. A metal pays you no interest, so when safe bonds pay well, money is supposed to leave metal and go collect the yield. That old inverse relationship, the one every desk relied on, has recently broken. Gold has climbed anyway, straight into the teeth of higher for longer. And when the oldest rulebook stops working, it usually means a bigger buyer with a different motive has walked into the room. A buyer who does not care about yield, because he is not there for yield. He is there because he no longer fully trusts the alternative. That buyer is the central banks, quietly accumulating, and it tells you the smart money is positioning for something the models have not caught up to yet. Silver, historically, is gold's louder, later echo. It waits, and then it moves in a hurry. So why does silver lag while gold shines? Part of it is exactly the mechanism we started with. Silver is a smaller, thinner, more leveraged market, which means the margin lever and the paper games hit it harder. It swings more. It gets shaken out more violently. A metal that can be knocked down 30% in days by a rule change, as it was in 2011, is a metal that will always feel like it is disappointing you right at the moment the fundamentals are strongest. The volatility is not evidence you are wrong. It is the fingerprint of the very leverage that is holding it back. Silver is not refusing to move. It is being sat on, and the ones sitting on it would very much prefer you interpret the stillness as failure and walk away. Let me put a face on this, because numbers on a screen do not capture what it feels like. Picture a man who has done everything right. He read the supply reports, he understood the deficit. He put a sensible slice of his savings into silver years ago because it made sense to him, and it still does. And now he sits at his kitchen table watching gold make headlines while his silver just sits there, and that small voice tells him he was foolish, that the smart people knew something he did not. He is not foolish. He is early. And the difference between early and wrong is only ever revealed by time and by nerve. The trading desks are betting he loses his nerve before time proves him right. Do not be the customer they are counting on. Which brings me to the recognition moment, the part one promise to save for the end, because it is the piece almost nobody will show you. Right now, the people who understand this are the central banks and a handful of sophisticated buyers, and they are already positioned. They are buying the physical metal in size and putting it away. The pension funds have not caught on. The financial media is still running the crash and bubble headlines. The average advisor will not mention silver to you at all, and that is the whole point. By the time it becomes obvious, by the time silver leads every news segment and every advisor suddenly recommends it, the easy part will already be behind us. The recognition always arrives after the repricing, not before. Nobody is going to call you and tell you the moment has come. Nobody sends you an invitation. The people who benefit are simply the ones who understood the machinery before the crowd did. We are not in that moment of broad recognition yet, and I want you to hear me clearly. That is precisely why this matters now. The window where a decision like this is still calm, still cheap, still fully reversible, is exactly the window when nothing feels urgent. When it finally feels urgent to everyone, the calm window will already be gone. So let me tell you honestly how to think about your own position, and then I will point you to the one thing that can help. Own the metal, not a paper promise on the metal, because the whole lesson of 2011 is that paper and leverage are where the games get played. Size your holdings so that a shakeout, and there will be shakeouts, can never force you to sell at the worst moment. And whatever you do not sell into the fear the desks are manufacturing. That is the mistake they are built to profit from. And I have to be straight with you, because trust is the only thing I am actually selling. I cannot promise you a price, and I cannot promise you a date. Silver is volatile, genuinely, and it can test you badly before it rewards you, if it rewards you at all on your timeline. This is a case built on structure and history and the behavior of the biggest buyers on earth. It is a case, not a guarantee, and nothing I have said is personal financial advice for your specific situation. What I can promise is that you now understand something most people never will, which is that silver isn't moving yet, not because the metal is weak, but because the cost of holding it is being controlled by people who profit from your confusion. So, if you have watched this far, you are exactly the person this last part is for. For those of you with $100,000 or more in a retirement account who want to think this through with a real human being, we hold a free, no obligation, one-on-one educational web conference. It is genuinely educational, not a sales ambush, and it is reserved for folks who watch to the end and mention that they did. There is no fake countdown here, and I will never insult you with one. The only honest reason to look at it now is the one I already gave you. The calm, reversible, unhurried moment to understand your options is the moment before everyone else is scrambling. And that moment is right now. If you are on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and we will get you the information and the time to talk. So let me leave you where we started, with that quiet frustration and that corrosive little voice telling you that silver failed you. It did not fail you. Go back to the spring of 2011 and remember what really happened. The metal did not change. A rule changed. The leverage got squeezed, the desks cashed in, and the honest holders who understood the difference stayed calm, while the frightened ones sold the bottom. That is the real reason silver isn't moving yet. Not weakness in the metal, a thumb on the scale, held there by people who need you to look away. Now you know where the thumb is. And the man at the kitchen table, the one who did everything right, he was never foolish. He was just early. And early, for the ones with the nerve to understand it, has always been the whole point.